This is Eat, Sleep, Invest, the marketing podcast for real estate investors to get more deals. Hey, welcome back, everyone, to another episode of Eat, Sleep, and Invest. I'm your host, Brian Driscoll, and I'm here with Jason Medley. What's going on, man?
What's up, brother? Glad to be on here today. Excited to share some scoop with your listeners and see if we can bring some value.
Good stuff, man. So, hey, Jason, I know you know a lot of people, but for the people that don't know you, give us a little background on what you do.
Sure. So my name's Jason Medley. I am first and foremost a father and husband. I live here in Tampa, Florida. My little girl, Ava, my wife, Jennifer. And then on the side, I run this thing called the Collective Genius, which I'm obviously joking. It is my full-time gig and has been for 12 plus years, but started CG about 12 years ago. And really what it is a peer-to-peer network or community, or some people call it a mastermind, where we bring together some of the top real estate investors from across the country. For example, Brian is a member of what we call CG Premier. CG Premier consists of about 185 pretty high-level investors. Our typical investor in the room is flipping 100-plus properties, and many of them flip thousands a year. So what we do is we bring them together once a quarter, and they share their systems, their strategies, their resources with each other to help each other elevate, grow, scale, and not just on a business level, but also on a personal level as well. A perfect example: Mr. Driscoll just got back from a kind of a mission trip, if you will, in Guatemala with some other members, where we raised the capital for that trip. We put that capital on the ground, and then our members went to serve on the ground as well. So it's not just about business; it's really a vast silo of success, if you will, that covers a lot of business, but a lot of who you are as a person, as a husband, a father, a spouse, a mother, a leader, etc. So
yeah, and
I don't know.
Yeah, and CG, just from my point of view, everyone always says get in the room with people that are above you. Get in the room with really smart people. That's the room. Just from my side, it's like, man, you got some wicked smart people in the group.
Well, we do. We have a lot of really smart people. And for those of you who are out there who obviously aren't doing 100 deals, we also have another structure called CG Select, which is, anywhere from 10 deals to 100. We have different levels there. But we got started at that kind of that higher level that Brian and I are talking about, the CG Premier level. And so, but yeah, a lot of smart people, and they're there to share. They're sharing everything with each other, and really it's not just about the sharing, it's about the connection that we create with one another. So if you say, hey, I've been buying all my properties at auction and now I need to create a sales floor, I have no idea what I'm doing. I don't know what the personality profile should be for the acquisition rep, what their comp structure should look like, what their job description should look like, how to train them, retain them, hire, if I don't know any of that stuff. Okay, no worry. We're going to put you together with somebody in the group who's an expert at that, and they're going to take you under their wing. They may let you come out to their office. Like it's really next level in regards to figuring out what you need help with, and then the members kind of take you up under their wing and help you grow. So that's what we do.
Yeah, it's a good environment too, because I know just me, and I think a lot of people in real estate and maybe in business, they don't really have people that they can talk about what they're dealing with, because you start talking numbers and cash on cash return, most people don't even know what you're talking about. So it's really good to surround yourself with people that are dealing with the same problems as you.
Yes, absolutely.
Okay, cool. So today, let's talk about investing. So everyone wants to be an investor, right? What are your thoughts on that?
So my thoughts are that investors shouldn't be investors right off the bat. And we're gonna talk about a topic today that is really kind of contrarian. But I can tell you, after number one, getting a complete butt whipping and butt wiping in 2008 personally, and in addition to that, having worked with some of the top entrepreneurs in the real estate investing space for the last 12 plus years, I've learned one thing to be true, and I'm hoping to share that truth with you today, which is making money is a skill set, but keeping it is a discipline. And there are plenty of folks who are good at making it, which can make you or create success for you short term. But if you want to have long-term success, you're not only going to have the skill set to make it, you're going to have the discipline to keep it. And so today, my goal is to walk you through why it makes, in most cases, right, that you can't put everyone in the box that we're going to talk about today. So we'll need to have a little bit of flex here, but I'm going to assume that I'm going to talk about creating wealth today in a way that's probably different than what you've been told in the past. And so I would encourage you to put your seatbelts on, be open-minded. And I asked Brian today if we could do like a screen share to where I could do my best to visually walk you through what I'm going to be discussing. That way it can, like for me, I'm a super visual learner. So we're going to do a screen share today to walk through as I'm talking kind of how, if you really want to be successful long-term as an investor, you should wait to quote unquote invest. So
I like it.
Yeah.
All right, so let's do it, man. So, all right, so we're talking about investing. So we have investors. Let's define what this is too. So we have people that call themselves investors that are wholesalers and they're flipping houses, and then we have people investing, buying properties that are kicking off cash flow. So which are we talking about here?
Yeah. So I would actually argue that a wholesaler or a rehabber, although in maybe less from the wholesale side, you obviously have expenses. You're investing, quote unquote, in the business, and then you're wholesaling property, or you're buying a property as a rehab. You are putting money to work. You're generating cash on cash return. But when I say investing, I'm more so talking about the separation or the differential between what is transactional, right, for your active business, your active income business, versus that which is not transactional, which is the wealth side of what you're trying to create as a true investor, where you're putting money to work into an environment or into an asset class that you've decided, like, that's going to be my jam for the next 15, 20 years. I'm going to build a portfolio of single family homes, or I'm going to buy an apartment complex where you get into self-storage. And so there's effectively a separation between the two, between your active income and your passive income. And I'm going to tell you today on what keeps most people from ever really getting where they want to get on both sides of the equation, right? Because what typically happens is you create an environment where if your active income is Peter and your passive income or building your wealth is through a portfolio is Paul, you're robbing Peter to pay Paul, and you can't do it, right? So what I want to do, I think first, is to start out and explain things conceptually, verbally, and then I want to actually go back through and kind of show, it ain't gonna be pretty, right? I'm trying to use a mouse to actually draw some a schematic of what I'm talking about. Okay, so if you're ready to rock and roll, Mr. Driscoll, I am, sir.
Let's do it.
Okay, so there's a couple of principles that you need to understand before we get rocking and rolling today, right? And that is that I firmly believe that all along the way, from an active income perspective, you have to account for the fact that the world throws you curveballs all the time, right? You have to expect the unexpected. And so if you're going to expect the unexpected, that means you have to prepare for the unexpected. So how do you prepare? Because you should prepare prior to building wealth, all right? So when you look at your active income, in most cases, if you're on this call, that probably means you're a wholesaler or a flipper, right? Somebody who's doing rehabs, or maybe doing, you have a turnkey business or whatever. But that's your active income. It's typically transactionally based, and it's something that you have to get to a point where it's consistent, predictable, and reliable. Now, what happens is that most people, because they want to be quote-unquote investors, right, they confuse their active income for what will be their passive income they're trying to build in the future. And so they get going a little bit, they start making a few bucks on the active income side, but what happens is once they get a few bucks, okay, I made $100,000 last year and I'm going to go take 30 of it and I'm going to go buy a rental, right? Okay, so you put $30K down on a rental, and that rental is going to spit off $200 a month if you're lucky, if nothing goes wrong, if it's probably just a recent rehab and there's no hiccups over the course of the year. You might be lucky if it spits off $150 to $200. That's cool, right? But let's talk about what happens in a multitude of facets to your active business. Number one, your active business, until you reach a point where it doesn't really need oxygen. I'm going to use a CPR analogy, right? Until you get your active business, your wholesaling, your rehabbing, whatever's your active business, until you reach a point where that business is consistent, predictable, and reliable, right? Consistent, predictable, and reliable, CPR. Until you reach that point, you shouldn't be stripping cash from it to buy rentals or to quote unquote invest in another asset class. Okay. And now I'm going to explain why. So let's go back to the first scenario. You're getting started in real estate. You made $100 grand, $200 grand, whatever it might be. And I would even go higher than that, 300, 400, 500, right? You start stripping the cash out over here to buy a few rentals. And then we go into an economic shift, much like we are at the time of this current recording. Okay. So you're making $250,000, but you're sucking a lot of the cash out, and you look over and you're like, wow, I got 10 rental properties. I'm doing all right. But then the market shifts, and what you really have at that current time is about $2,000 a month in quote unquote so-called passive income. When things get dicey, would you rather have $2,000 of income on a monthly basis from those rentals? Or would you rather have the 30 grand a pop for each of the 10 rentals that you bought, which is $300,000 in cash in your possession when things get scary or things get bumpy or things get choppy? Because the moment that it enters into your mind that your income could get cut in half, or you could have to have a new business model, or you start thinking about protection. Do I have the ability to protect my family? Do I have the ability to protect my business? When you get to the point where something has happened in life and you are asking yourself, do I have the ability to protect blank? When you fill in the blank, those are the things that should come first. Those are the things that should be priority to where you can answer the question, yes, I do have the ability to protect my family and my business. You should be able to answer yes to those before you start building and buying and building assets. All right? Because again, go back to it. Crap hits the fan, things slow down dramatically, your income gets compressed, and you're like, oh, $2,000 a month on 10 rental properties isn't going to do a lot for me, right? But I've got 30 grand in each one of those houses. I wish I had that 300 grand right now because my business has been punched in the mouth. I'm scared to death. I'm nervous. My spouse is tripping out. I don't know if I'm going to be able, like, you, boom, 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 right? That is what most people do because they live in the moment. And so let's go back to the fact that you have to live in an environment to expect the unexpected. Period. It's going to happen. If I can list them out, I'll be glad to. Right now, the Fed decides to throttle interest rates, right? Number one. Number two could be COVID. Number three could be 2008. Could be 9/11. Like it's going to happen. It happens. And so you have to build a life before you start on the asset side, the wealth side that creates protection measures in times like that. And now I'm going to tell you how to do that. Okay. So what I want to share with you today is what I believe in and what has served me well from a wealth creation standpoint is a process that will ensure, right, first and foremost, that you can answer those questions, right? Do I have the ability to protect when you fill in those blanks, which for most people, it's their family and their business, right? It's usually the answer to those questions. I'm going to walk you through a structure that should, if you follow it, it's again, I said it's a discipline. It's not a skill set. This is not something you have to be smart to implement. It really is. It's not about being smart. It's about being methodical. Okay. So it's not about smart. It's about being methodical. It's a methodical discipline that if you follow this path, it is yours to mess up, to not end up incredibly wealthy. And that's the straight dope right there. I've seen this done so many times. I've utilized it myself for probably 8+ years. It's changed my life. And I've got to see the downside of not doing it with a lot of folks who, again, I've been working with high-level entrepreneurs for 12 plus years. So what I want to do now is kind of take what I've shared with you verbally, add a little bit more color to it, and then I'm going to draw it on the screen so that the mechanics of it can kind of get set in your brain. All right.
And you know what, Jason, this is huge too, because especially in this market, I saw a lot of investors panicking just because their flips didn't sell. And I think that's what you're getting at, because if market changes, your cash gets cut off. You got what, 1 month, 2 months? Most people, they can live until they go into panic mode.
Right. Well, it's funny you say that. I had an investor the other day. He'd say, you know what? Well, I can't do that because I'm trying to grow my business. I'm like, you trying to grow your business or your bank account? Right? You want to do 100 flips and be living on the razor's edge, or do you want to do 60 and be wealthy? The choice is yours.
Mm-hmm.
Right? So what happens there in that situation is you're scaling too fast. You can scale out of profitability, right? You can be making a ton of money, but if you're constantly applying leverage against it, if it's too out of balance, you get popped. And even if you're not flipping homes or like rehabbing, even if you're just wholesaling, but you're expanding your team, you're going to new geographies, and you're taking all your profit and you're utilizing it for growth and never taking chips off the table, okay? Never taking chips off the table. It's like playing blackjack. This isn't rocket science, right? You win 6 hands, 7 hands, 8 hands, you start getting a little cocky. You're like, man, I'm pretty good. I'm rocking this. Let me just put it all in all the time. We've all sat at the blackjack table where eventually the 21 gets turned over by the dealer. Business is no different. You can't be all in all the time. And so if you apply the right disciplines and put those right disciplines in place, you should create an environment where when the dealer turns over blackjack, you've still got some chips in your pocket. You can walk out, have one final cocktail, go home and relax, right? So I'm going to give this to you, all right? You got to first understand the methodologies, if you will, of you should always be taking chips off the table. Why should you be taking chips off the table? Because you need to be able to answer those questions. Can I protect my business? Can I protect my family? With a yes, all right? Profit is more than a number that shows up on the bottom right-hand corner of your P&L. If you scale and scale and scale at a pace that outstrips that profit, it's not really profit. And you're all in all the time, the 21 comes up, okay? So if you understand that conceptually, now we're going to tell you from a disciplinary standpoint what you should be doing. You should put at I would say until you get to the point, like legit, where you are netting $500,000, you should put all your efforts and energies. Now again, this is different. If you're a corporate employee, you make $200,000 a year and you're going to do that for the rest of your life and you want to buy one property at a time. But I'm assuming our audience is full of wholesalers and flippers, right? Before you start investing, you should get your current income to where it is consistent, predictable, and reliable for several years in a row, right? I would encourage you to get it to the point where you are at least netting $500,000, okay? Because that's your structure, that's your pump, that's your foundation. The fastest path to a big passive income is to create a big active income. So if you start there, where I'm just going to grow the heck out of this core business, where it's consistent, predictable, and reliable, and then you get to the point where you're like, okay, I'm netting $500,000, $1 million, $2 million, whatever it is, and you say, okay, I'm making more money than I can spend. I've got the house, I've got cars, my kids are going to good schools, like, I'm good. I can't even spend all this money, right? So what needs to happen at that point is you got your stuff, but do you really have security? Can I provide if something goes sideways for my family, for my business? So you've got different buckets. You've got your pump, right, which is your core income. You've got retained earnings for your business. You've got retained earnings for your family. And then you've got a tax bucket. And then after all of that, you've got investing, okay, or your passive income. And there's more to passive income than just passive income. It can be used obviously as a tax mechanism from to depreciation and offset income and stuff. But I want to kind of try to keep things fairly simple today, okay? So you get to the point where you look up and you're like, my active income is pretty strong. It's consistent, predictable, reliable. I have more than I need. I'm not stripping money off of it to go buy assets or stupid stuff that initially don't really give me what I need back, a couple $100 a month. What I am going to do now, I've got more than I need. I'm going to set some thresholds. I'm going to have these buckets over here for my family and for my business. And I'm going to establish an amount to say, you know what? It cost me $150,000 to live. And so I want to have 18 months of reserves in case something gets choppy, to make sure that I can navigate that choppiness from a place of emotional intelligence and not have to stress out and have my family be stressed out. So I can live on $150, $200. I'm making $500. After taxes, I'm pulling down $350, $400, whatever it may be. I'm going to start taking that excess money and I'm going to start putting $20,000 a month over into, until I hit, say, I don't know, what is that? I need 18 months at
like 150, 200.
Yeah, call it 200. I'm going to put $20,000 a month over into my family bucket for 10 months until I got $200,000 in just cash, right? And then I say, okay, my family's good. They're my primary priority. Now I'm going to go over here and I'm going to do the same for my business, right? And depending upon what your expenses are, et cetera, you're going to have to come to some conclusion to say, hey, it takes me X amount of dollars to operate on a monthly basis, and I want to have, call it a year's worth of cash to cover operating expenses if things get sideways, okay? And so let's just say that's another $200,000. And so then for 10 more months, you put $20,000 into that. And then you say, okay, I've hit my thresholds, right? I've hit my thresholds. I've got a consistent, predictable, reliable income. I've got $200,000 in cash for my family in case things get rocky. I've got $200,000 for my business in case things get rocky. And now at that moment, I say, I've been putting $20,000 a month away, right? Every month for 20 months, I'm disciplined. I got a process, but now I've hit those thresholds. So I've created responsibility, right? Or I've been responsible in that structure. But if I were to put any more money in those buckets, I might be teetering on the verge of irresponsible, because you don't want to have too much sitting idle. So now, every month after I hit the thresholds for my family, my business, taxes, I'm going to start being an investor, a real investor. So if it was $20,000 a month, and it takes you $30,000, let's just say $30,000 to buy a house, that assuming there's debt tied to it, every month and a half, you have enough money to buy a house. And it's only $200 net. But here's the beauty of it. Now you need to buy houses not only to begin creating passive income, the cash flow from the rentals, but your income is elevated to a point where you need the depreciation mechanism to begin offsetting your active income, okay? So you're killing multiple birds with one stone, but you're doing it at the right time instead of too early in your journey where you are trying to go straight to the investing bucket and sucking the oxygen out of your business that hampers it from growth, reduces predictability, and puts you in an environment where you got a couple of rentals spitting off a few bucks a month, but when shit hits the fan, or when things get a little choppy, you're like, I don't have any money because it's all locked up in those properties, right? Now, once you get to that point, you got enough money if every month and a half to buy another rental and another rental and another rental and another rental. But it all goes back to the initial focus of putting a big focus on creating a big active income. That takes care of everything else on the backside. It takes care of your family, it takes care of your business, and it allows you to build wealth. And again, if you think about it, you've got your skill set in the active income column, and then everything behind it is just a matter of discipline. It's just a matter of discipline to put the $20,000 a month in for 10 months for your family. It's just a matter of discipline to put the $20,000 a month away for your business. It's just a matter of discipline to take $20,000 that month, $10,000 halfway through the next month and buying a new rental. It's not about skill set. It's not about intelligence. It's not about brains. It's just process.
I like it, man. You're buying peace of mind.
Yes. And I can tell you, when things get choppy, there's only two things you want. That's cash and peace of mind. And they usually go together.
And your decisions are swayed too. When you're under stress, like when the pandemic happened, if you have a bucket of cash sitting there, you make decisions way differently than if you don't.
Yeah. Yeah, completely. So what I would like to do is, I'm a visual learner. I know I've explained it verbally, but I'm going to do a quick screen share and kind of draw this out so it makes sense. All right. Maybe it'll register a little. You get to hear it a second time. And it'll register. So just bear with me, and then Brian, let me know once you can see my screen.
Yep, I see it coming up. Anyone listening to this on audio too, check it out on our website or YouTube. You'll be able to see the video.
All right. So think of this, right? This is your business. This is your active income. Okay. This is one bucket. Okay. And now your second bucket, right? That's like your family reserves. Okay. And I know this isn't real pretty, but this trying to draw on a mouse is about as good as it's gonna get right now. So your third bucket is your business reserves. Right? Third bucket is business reserves. There's actually another bucket in here between, which we kind of didn't speak of too much, but is your taxes, right? And then your fifth bucket, right, is your passive income or your wealth. I'll put a PI/wealth here. So what most investors typically do is they get a little bit going here. They're making a few bucks. Then they start taking those a few bucks and they bypass all of these buckets, which are most important, and they come over here and they start to become a quote unquote investor, right? This is really active income. It's transactional based. It's like any other business. I respect the fact you're making a cash on cash return on your money, etc. But in reality, it's transactional based. This is where you really become an investor, right? And so most folks, they start making a few bucks here, they skip all of these other relevant buckets, and then when things get a little bit rocky, okay, they realize, wow, I don't have the ability to take care of these buckets. I don't have the ability to take care of my family, my business, taxes, any of that, because what have I done? I've went straight to the wealth bucket right here. All right? Because you took oxygen from your active income, your business, which you need to grow it, make it better, hire employees, invest in systems, etc. And you've stripped it from the ability to do that in exchange for, in the beginning, a few rental properties that throw off a few bucks. When things get rocky, what would you rather have? A few bucks over here coming in from a rent perspective, say on like 10 rentals, or let's do 20, $4,000 a month if things are going great. But then you're like, okay, $4,000 a month is not taking care of this bracket of 3 buckets if things get choppy, if things get bumpy, if the Fed decides to raise interest rates 14 times over 8 months, right? Like I know it's not been 14 times over 8 months, but you get my point. It's been a lot. It's been quick. Or COVID hits or whatever, right? When things get rocky, and it will, you have to expect the unexpected. That is why these brackets have to be taken care of first before you hit the passive income wealth bracket or bucket. So how do you do that, right? The first thing is to ensure that you get your business in a position where it is consistent, predictable, and reliable. Okay, you get to the point where you're like, I've got a good team. We're functioning as a team pretty well. I'm making way more money than I actually need to live. I've made more money than I actually need to live on a consistent basis, month over month, maybe even a couple years at a time is my suggestion. And the business has got CPRs, consistent, predictable, and reliable. It's got the oxygen it needs. And then what happens is you look up and you say, okay, this has got me in a situation where, let's just say I'm living on 200, right? Living on 200 grand, but I'm making 500 because I've been putting all of my emphasis on this, my active income. I say, wow, I've got 300 grand differential. I mean, obviously, I understand there's tax factors in place. We're just trying to give you an understanding of how these principles work. I got 500 grand. I'm living on 200. I got 300 grand. So I'm going to keep some of this to continue to grow my business, but I'm going to start putting, 20 grand a month away for 10 months to get to the point where I've got 200 grand in my family bucket. And then when I get to that 200 grand threshold, I'm going to do it where I put it in my business bucket to handle any bumps there. And all along the way, obviously, you've got to be allocating for taxes. And so what happens is you are putting your priorities first, okay? Doesn't matter if you're wealthy or you are trying to build a path to wealth if you can't take care of your family and your business, because you'll never get to the wealth part. Ain't going to happen, all right? Put your priorities first. Take your excess, implement the disciplines, right? This is the skill set part. That's an ugly S, okay? This is the skill set part, the active income. This part right here, everything from here back is all discipline. It is systematic. It is methodical. You don't have to be smart. You don't have to be hyper intelligent. You need to be disciplined and methodical. And if you are, I can guarantee you will end up wealthy. And why is that? Because number one, when you hit these thresholds of, say, 200 grand in the family bucket, in the business bucket, you say, all right, I've been responsible, right? Like if things get bumpy, I'm good. And I can navigate without just being a complete emotional mess. But if I put more money there to sit idle, and it doesn't always have to sit idle, like I don't just put my money into a non-issue. You could do a high yield savings account or something that's making you something. So, but main takeaway there is it's low yield. It's not really investable. It's there for you to have your hands off of it. Point is, when you get to those thresholds, I've been responsible, but any more cash not making a good return is somewhat irresponsible. And so now I'm going to take the 20K I was putting away every month into these buckets, and I'm going to come over when it's time for me to actually start building wealth. I'm going to come over into and start activating the wealth bucket. So let's just say you're in the Midwest. You can go get a house with a down payment, closing costs, and everything for $30K, right? So now, because you were putting $20K a month away to build your reserves and protection measures, every 1.5 months, right? Every 1.5 months, you have enough money to buy another property every month and a half. So you're buying on average 6 to 8 properties a year, and then all you have to do is remain disciplined. And what happens is this will start to grow because we follow this system. This 500 doesn't stop at 500. It turns to 750. It turns to $1 million. Then you start scaling how fast you're buying properties. And then this is now, right, the wealth bucket, buying assets, if it's real estate in any shape, form, or facet, is going to allow you, as you buy them, to apply depreciation towards your income, which will help you from a tax perspective. Let's say you get to the point where you're buying 20 properties a year. In 5 years, you got to ramp up year 1, year 2. You're not at 20, you get to 20 in year 3. So over the last 3 years, you're at 60. Maybe it was 10 the first. You got 80 properties in 5 years. But it doesn't function like that unless you start with your focus here. And then you create the protection measures for your family and for your business and allocate for the taxes. Then you've got safety, you've got cash, you've got some security bumps in the road. Then you say, I've hit my thresholds. I'm good for how many ever years in each of those categories. Some people say 6 months, some people a year and a half. You got to figure that out yourself, right? But then all the money goes to the wealth bucket. And then it starts functioning and firing on all cylinders.
You know what the cool thing is too with that, Jason? Once you fill a bucket, it's filled. So it's like you fill one up and it's like you do that one time, then you move on to the next. It's not like you have to keep doing it.
Well, I mean, my there's layers. That was a very elementary discussion to help everybody really kind of understand the concepts and the principles behind it. There are layers behind it. I think as your business scales, as your active income scales, as you get more employees, or say, for example, rehabbing, right? Rehabbing takes a lot of cash. You're typically bringing a portion of the money to close. The more deals you're doing, the more cash you have outlay. So I think as your business scales, you have an initial threshold in those buckets from a family perspective and from a business perspective. But as your business grows, you should come back in and revisit your thresholds, right? And because your income is, now you're not at 50 or 500 grand, you're at $1 million. And you're like, this is just, there's so much additional money here than what I need for me and my family to live well. So I'm going to go from 200 in each of those buckets to 400 in each of those buckets, right? Because probably somewhere along the way, you went and got a nicer house, nicer cars, different stuff. It costs you more to live. And now your business has grown. You got more employees, more overhead. And so you need to kind of come back in on occasion and revisit even the threshold you set initially, right? But I can't stress enough that if you focus on making a big active income, well before you get into stripping that off and stripping your business of oxygen, which is the cash, and trying to go straight to the investing bucket, that's a recipe for, it's not necessarily a recipe for disaster, but it is a slow, grindy process that doesn't usually end successfully, because you're trying to feed two beasts, and both of those beasts are hungry. Feed the one that's going to take the best care of you initially, which is your active business. Everything behind it. If you get really good at that, you don't really have to be good at all the buckets behind it, because they're not skill set driven, they're discipline driven. Does that make sense?
Yeah, 100%, man.
Yeah. You don't need rocket science to set up automated transfers every month to those buckets. You don't need rocket science to, hey, every month and a half now I'm going to go buy it. Like, that's just disciplinary, methodical structure, right?
Yeah, 100%.
The front is on the skill set.
Yeah, and that's what I like. I like working with you guys at Collective Genius too, because there's conversations like these. Like, these are the types of things that people in business need to know, because you might go down the wrong road, keep buying properties, things like that, and something pops up, and boom, you have to fire sale everything to save your own house.
Well, and you get guys too, like right now they're like, oh man, I didn't make any money last year. I'm like, well, how many doors did you add to your portfolio? Well, I added 60 doors. I'm like, okay, you made a ton of money, but instead of it being on your P&L, it's on your balance sheet, right? You didn't sell them. You could have sold each one of those for 20 grand and made $1 million, but instead you kept them and they're in your portfolio, and you're mentally in anguish about not making any money. You made plenty of it. You just chose to keep it's more on the balance sheet side of things than it is on the P&L, right? And then I'm struggling. I can't. I don't have the ability to hire people, and it's like, you're rich. You got a portfolio with 200 units in it, $8 million worth of equity. Talking about can't hire somebody. Like, stop buying rentals for 6 months, and start buying.
That's a real problem too. I hear that from a lot of people. Like, same thing. I hear it last year. Yeah, I didn't really make any money. Like, that's a real thing people are telling you.
Yeah, but they put 40 properties or 30 properties or 100 properties in their portfolio. They made plenty of money. They just decided, instead of harvesting at that moment, right? But that's part of the lesson here. You can't eat equity.
Right. Yeah,
You can't eat equity.
that is true.
Yeah.
Yep.
So you need it. You want to have it long term, but trying to focus too much on building equity and being assets too soon is yeah.
Well, I like how you put that out too, because you're basically protecting yourself for tomorrow. And then when you get to the stage of equity, things like that, investing, you're pushing that money to the future. And you're allowing that money to stay in the future because you created a safeguard for when shit hits fan tomorrow.
Yeah, because it does. It always does. It will. I mean, that's just how it works. I mean, every 7 to 10 years, something's going to get, and those are the things outside of your control. I mean, there's other things in your life, you know, that can happen outside of COVIDs and interest rates and, you know, terrorist attacks. Those are the things that are, you know, external. There's plenty of other things that make it hard enough.
Yeah, and there's a lot of the stuff you just can't control, like even health, things like that pop up. You know, it's just like life happens, so protect for it.
Yeah, you got to expect the unexpected, and you have to prepare for it. I always say at CG, our job is never to predict the future for our members. It is to prepare them for the future, regardless of what happens.
Yeah, I remember you guys were predicting. When was it? I think it was back in June or July last year, saying something's happening. You guys better buckle up. You better have cash sitting.
It was well before that.
Yeah.
Well before that. Quite honestly, those mantras that we start out with at every CG. I mean, you haven't been a member that long, right? But those mantras of take chips off the table, profits more than the number that shows up in the bottom right-hand corner of your P&L, like all those, there's about 8 of them. I won't go through all of them, but those are all, they're there for a reason. Whether good things are, whether the market's rocking or it's not, those are principles that should be lived by. And the thing, like we started well before that. I think the marked moment was at the end of, honestly, 2021. We had a guest speaker come in, and we were just all on the same page that it is time to get liquid. You know, it doesn't mean liquidate everything. It just means if you weren't liquid, if you didn't have any liquidity, no cash, you need to get some. Even if that means, here's the other crazier side of it, right? Here's the other crazier side of it is people get so married to assets or to the portfolio that they can say, I have this conversation. How much equity is in your portfolio today at today's prices, right? 2023. Oh, there's just $11 million. Okay. And you're calling me saying you have a cash problem? You'd rather die on the vine and struggle like hell instead of selling a few doors?
Right.
Just sell a few doors and take the torment away.
Yeah.
You know?
Exactly.
Yeah.
Hey, one other thing before we close too, because I remember back to whenever I heard you guys talking about it in June or whatever it was, and it's interesting too because when everything's going good, pull some chips off because when shit hits the fan, you have to be liquid because opportunity pops up so fast and then it just disappears.
Yes, exactly.
You know,
exactly. You should always be pulling chips off the table. That's just my personal. And again, until you get to the point where it's just so, if you get to a point where you have so much cash that you got it in a low yield, like a high yield savings account or something like treasuries, and it pays for your living expenses, like you get to that point, it's, maybe you don't keep pulling cash off the table, but I just think I think each of those buckets we just talked about should continue to grow as you.
Right. I agree.
Right. Absolutely. 100%. Because every part of your life, if you okay, my thresholds are 200 grand. Okay. Well, we've changed our standard of living. So now we need 400 grand. And the business that I set out to have 200 grand in reserves for is now, doing $10 million a year. Well, that 200 grand is that 200 grand would evaporate in a month. Right. So I think you've got to always be elevating each of those buckets.
Yeah. So let's talk about CG real quick. So the members, so we have a lot of real estate investors that listen, right? Mm-hmm. And a lot of guys are just out there doing their own thing. They don't even know. They're just hustling, right? Who's a good fit? Which type of people are good fits for Select and Premier?
Yeah. So at a select level, it's typically somebody who's doing anywhere between like 20 to 100 deals, and again, we're actually beginning to break you down into categories. Like when you come, you'll be in a room with everybody, the biggest players and the smallest players all in one room day one, and then day two we break down people by their volume. So if you're doing 20 to 40 deals, you'll be in a room, 40 to 60 deals, etc. So anywhere between 20 and 100. And it's really more so when you're at a point where if you don't have a mission, vision, core values, a team that's operating under, on a set of KPIs with accountability, and, financials like P&L, balance sheet, et cetera, that you have on a monthly basis, in and out. If you don't have those things, you should be in select, right? If you have those things and you have a business that's either doing 100 plus deals, or maybe you're apartments and you've got 1,000 plus doors, or what have you, Premier is that's typically somebody who's typically been in the business for a while. They've got a decent sized team. They're probably doing, probably have at least a $3 million business on the low side, and the high side goes I think our biggest one is almost 200 million. So that's kind of the differentiation. You've got more of an established team. You got select is for when we're trying to take a quote unquote investor and get them to the point where they actually have a real estate investing business. Right. And then once you've got an actual business and you're kind of firing on all cylinders, you've got a team that's functioning on, accountability, et cetera. That's the players room, right? That's CG Premier, and that's you've been in there. There's guys that are big hitters in there. I mean, I was on a call yesterday with one of our members, and he just put $1 million into another member's fund that's given a 2x depreciation multiple back, right? So those are the kind of gals that are in that room that are, that are playing at a high level.
Yeah, and anyone listening too, because I talked to some people like, oh, I wanted to get into the Premier, but there's different it depends on what stage of your career you're at, what problems you have. So if you're in the earlier stages, select is the room you want to be in because they're talking about building the business still. First, the Premier guys aren't talking about that. They already have their team, so there's different problems in each room, and find out what kind of problems you have, because you want to be in that room with the guys that are solving that.
Well, you have to place some trust in us, and that after 12 years, trust me, we'd rather put everybody in Premier. It's almost twice the cost, right? So, let's just keep it real. So if we're telling you to, what's best for you with where you're at is select, you've got to know that that's what's best for you. Because if we were doing what's best for us, we'd be like, hey, even though they're not really ready, Premier is cost almost twice as much, and so let's put them in Premier if they've got the money, right? That's not what we do. We want to do what is best for you with where you're at, right? That's literally what we just got done talking about. Where most people make the mistake is they start allocating money in a way that's not best for them with where they're at in their careers or their income, right? We just showed you the progression of how it should go, right, as you move through that cycle. And if you were to apply to CG, you got to place some trust in us that we know what's best for you, and where you should be. Because quite honestly, if we put you in Premier and you shouldn't be in Premier, it's going to be overwhelming. It actually would be detrimental rather than helpful, right? I know there's the love affair with, I want to hang out with the top of the heap. I get it. I completely get it. But in some cases, there's such a distance, such a gap, that it's actually not productive for you.
Yeah, so if somebody wants to apply, what's the best way where they go?
Sure. There's a couple of different places it can go. You can go to learn more about CG, and that'll just give you a ton of real life examples of how members are helping each other, what type of content and environment that we provide in our events, how they're spending time, how they're engaging, how they're helping each other make money. Just a lot of stories and that will break that down for you.
And then learn more about CG.com.
Yeah, learn more about CG.com. And then if you kind of want to see like behind the scenes of what an event looks like and who's there and etc., you can go to dominatethedownturn.com. Those are just a couple different landing pages that we have. They're different. So that's, some people would say it's a cardinal sin to get 2 domains, but whatever. I know we'll attract the right people if they're supposed to be here. So again, that last one's Dominate the Downturn, and that's really literally showing you footage behind the scenes of the people that are there and how an event is typically actually structured.
That's cool. Yeah, and then basically the way the process works, they would apply, then they'd have a conversation with somebody over at your organization and determine if there's synergy and a fit, right?
Yeah. I mean, we have a very specific type of culture. We're looking for a fit. Just as you're kind of screening us to figure out if you want to be a part of it, we're screening you to figure out if you would be a good fit, if we can actually deliver value for you. The way that's driven is you fill out a short application, you schedule a call with our team. You'll get on there. We'll kind of attack what your core biggest issues or challenges are, or maybe the goals that you're trying to accomplish. We'll dig into those and then really kind of lay out a plan of the who can help you and what can help you inside of CG.
All right, cool. Hey, everyone listening, we'll put those in the show notes too, so you can check out those websites there. Hey, Jason, thanks for coming on, man. We appreciate you.
Yeah, man. Thank you. I appreciate the opportunity as well.
Hey, what's your top book?
Right now, I'll preface this short and sweet. I have hundreds and hundreds and hundreds of books at my home. Hundreds and hundreds and hundreds of them I've read less than probably 40 pages. There are 4 that rest on my nightstand. Up until recently, there were 3. Now there's 4. The new 4th book, actually, I've actually got it right here. This is a pretty, everyone wears the title CEO, but we don't usually behave like CEOs. This book right here is changing the game. It'll be the 4th book on the nightstand, and the books on the nightstand, not the bookshelves, but the books on the nightstands are the ones that I keep close to the heart.
Like, what is that? Buy back your time?
It really talks about structuring your life from a productivity standpoint, as to like how a real CEO does that.
Okay, who's the author on that? 'Cause I'll put that in the show notes too.
Yeah, it's Dan Martell.
Martell, Buy Back Your Time. Cool, man. Yeah, thanks, man. Appreciate it.
Yeah, it's an epic book. Absolutely.
Awesome. Hey, well, thanks for coming on, man. And hey, everyone, thanks for listening. Until next time, get out there, crush it, close some deals. We'll see you next time. Thanks, Jason.
All right.